Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Again, you're going to lose time.
Okay. Can you just go back through the U.S. dollar index? I know that you can't trade that at the ISE, but a lot of people do watch it. Can you just explain why it's so important?
Well, it happens to be a basket against the six currencies: euro, yen, pound, Swiss, krona. It's been around for a long time, ever since the Bretton Woods agreement was done. I don't know if you can see my desktop to where I can actually bring up a live chart of it. I don't know if you're still viewing my desktop.
If you wanted to switch it, you could. We don't have to, though. I mean, it's up to you. If you want to, you could actually share desktop and move away. That's up to you, Steve.
See, the key thing about it, Steve, is let me bring up a chart, and then I'll actually share the desktop here a second. Okay. The key thing about it is it's got history that goes all the way back. And above the levels of where we're at, I'll just talk it through. Above the levels of where we're at right now are pockets where prices have turned in the past, supply levels. And one of the people that I worked with that's helped me tremendously in my trading is a gentleman named Sam Seiden, who's also a fellow instructor here at the Online Trading Academy. He's actually he's more in the electronic classroom settings that we have. Sam was a floor trader on the Chicago Mercantile Exchange, but he was outside the pits. And when he was outside the pits, he handled the institutional order flow. And he would actually get the orders from the institutions in the morning, and he'd stack the orders on his desk in a pile by size. And the place where he had the biggest buy orders and the place where he had the biggest sell orders above and below current price would be where, prices would turn. Obviously, if there's 50,000 to sell at 90 on the dollar index and only 20,000 to buy, once the last buy order's filled, prices are probably going to turn lower.
Right.
So when he explained that to me, he showed me what that looked like on a price chart, and it's improved my trading absolutely tremendously. It's probably I can't say enough. It's the secret to what I do. Now, prices don't always turn, and we're talking about areas of supply from back in 06 here, but it's uncanny that you can find these areas. I've heard Jason talk about them on your presentations. So he's talking about these areas too, and they're very, very important to know. So this dollar index chart has all these supply levels from way back. Once we get past this 92 area, we probably got some supply to worry about at around 98. After that, about 105. So by using this index along with your indexes, I can look at indexes that don't have as much history, and I can look for places where prices to take profits or actually to put on trades expecting prices to stall and put on spreads, et cetera.
Understood. I don't want to hold you up too long, Steve. Let's take two or three more questions. Let's see. Mike wants to know, which moving averages do you use? And I get this question all the time. Do you look at daily, weekly, or monthly, or do you actually try to use them all?
The gentleman who came up with the 4 stages, and he didn't come up with it, but he must have heard about it from somebody else in the 30s. There's a guy named Stan Weinstein, wrote a great book, Secrets for Profiting in Bull or Bear Markets. Talks about the 4 stages. Isn't it great?
Yes, great book.
It's so fantastic. Now, he only used a 30-weighted moving average on a weekly chart, and he wrote the book in '88, so he had to hand draw the moving averages on his chart. So, now I've got the computer power. I don't have to do the hand drawing. But you know what? It worked so well in 1988, and this is 2009, and he used it for 25 years before he wrote the book. So it shows you greed. It shows you fear. It's a great trail stop. You use a 30-weighted moving average. I use it on every one of my charts. I just sort of leave it on there, and it's really helpful. Now, if you want to be a trader, more active trader, Mr. Weinstein used a 10-period moving average. So if you want to get more trades, you can use the 10 in addition to the 30.
Thank you.
Sure.
Ed is a frequent attendee. He comes to just about every week, every webinar. So he has a great question, and he wants to know, he's very interested in correlations. He says that the correlation between euro and dollar, although they seem slightly negative, seem to be more than random. Any thoughts if we see it developing?
Well, there's no randomness in really with the currencies. Yeah, they all are correlated. Right now, though, fundamentally, we have to worry about the bank exposures, and really, we haven't probably heard about all the problems in the European banks. Plus, as you know, there's a few countries making noise about pulling out of the euro. So there could be some turmoil in that currency. It definitely could. It definitely could have some turmoil like the British pound type of turmoil. You see how much that collapsed.
Absolutely. In fact, that's the problem with the euro now, right, is that these countries that are having problems, they don't have their own currencies to devalue, which makes it even a more difficult situation, right? Because the British economy, they could devalue and probably work themselves out of it.
Yes, exactly. Yeah, they're tied to Germany, and even Germany's not happy anymore. So, yeah, that experiment's made it through 10 years, but there's a lot of people asking great questions about how much longer that's going to last. And
right.
And if, of course, any kind of turmoil in that currency, and people will vote with their feet for sure.
Oh, absolutely. Lewis has a question. He says, at this moment, the par. I'm sorry, I'm just trying to read through this. At this moment, the U.S. dollar, Japanese yen, again, that's the IC symbol yuck, is upward trending, and it's almost near par. What do you see there? Do you look back at 3 or 4 or 5 months ago and see the U.S. dollar selling off, or do you know, right now, are you just looking at that shorter-term uptrend?
Well, first off, that's a great question. It's not going to be a smooth shot for the dollar all the way back to the top of the chart. So you do want to look to the left of your chart and look for areas where prices were pretty much imbalanced for periods of time, followed by sharp sell-offs. You can find those pretty easy if you're looking for them, but the problem is most traders never look to the left to figure out what's going to happen to the right. So when I look at like this weekly chart of the Japanese yen, around 108 or so, there's going to be one of those areas where we based for a few weeks at between 108 and 110, and we collapsed. So if we were to come up there, I expect probably at least enough sideways action until those orders are worked off. Remember now, if there's an order to sell at 108, for example, and price all of a sudden falls to 107, if it's a limit order, it can only be filled at 108 or higher. So if it falls really, really fast, there's a good chance that order is going to be left over for the next time price comes over there because it never got a chance to get filled. So again, all of this again is from working with Sam Seiden, and he explained it pretty much as simply as read Economics 101, and you can figure out what's going to happen on your currency charts. Supply and demand.
Right. So, you know, when you're trading these, though, and you do see one that's what I would say is so overbought, what do you try to do? Maybe you're in this position and you have a profit, but you've seen, and I guess your best example, although there was a lot of them, but the Australian example where you saw that, that basically a rocket ship up. How do you keep yourself in the trade but not so scared because you're so far away from all your moving averages? And I think you actually talked about shortening your moving averages. Is that one strategy that you would use?
Yeah, the 10-period moving average gets a chance to catch up to price faster than the 30. So you could now see that's the best question of all, because that's the $64 question. When you break out of the top of that stage 3 top, you usually start that stage 4 decline phase. So where do you get out the fastest? Well,
thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.